It was a quiet day in the stock market with the S&P 500 closing down just fractionally. But oddly enough, in tonight's video, we'll look underneath the hood and find that we only had a third of the stocks that were in the green today. 2/3 of them were in the red despite today's flat performance. And the reason behind that was largely as a result of just two companies. Tesla and Nvidia had tremendous days to the upside, offsetting weakness in many of the smaller companies that were out there. So we'll have that discussion, see what it means for our various indices and their postures. We did have some posture changes in tonight's video. We'll also have a chat about some of the different asset classes like gold and oil and interest rates, and then we'll get into some sector analysis, see which sectors are doing well versus the ones that are falling off the wayside, and then we'll have our trade application example where I've got something special for all of you lovebirds out there today on Valentine's Day. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 14th, 2023. Happy Valentine's Day, one and all. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee, and we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at the web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see with our heat map here, we had a lot more stocks that were down today than were up. I was actually a little surprised by this when I pulled it up. I hadn't pulled the heat map up until here right before I was scheduled to do the video. And I assumed it would be about an equal split today because when I looked at the end result of the S&P 500, it was basically as flat as a board. In other words, basically right there trading at the same level that we were trading at yesterday at the close. And so oftentimes on days like that, you have about as many stocks that are up as are down, and they kind of balance each other out. Today didn't really feel that way, strangely enough. And then I figured, well, if that's the case, then we probably had, Apple and Microsoft, pulling their weight a little bit more heavily. And in at least today's case, Apple was actually down, not by much, but down by 0.42%. But Microsoft was up, so to be fair, they helped out a little bit. But as I look at this, I guess the reason that the market was able to withstand the onslaught of so many more companies down than up today was because of Nvidia and Tesla. While those two are not as important as Apple and Microsoft, they are still moderately important, and the fact that they were up so much kind of gives them a little bit of extra oomph there in that regard as well. So Nvidia was up 5.5% today, and Tesla was up 7.5% today. Just remarkable to see Tesla roaring higher on a year-to-date basis after such a terrible 2022. So from my eyes perspective, we can send our thank you cards or perhaps our Valentines on a day like today to Nvidia and Tesla. Without those two, I have a feeling that today's end result of the S&P 500 would have been much worse. In terms of the other big players out there, you saw that Google had basically a flat day. It was down just fractionally. Berkshire Hathaway was down about 1%. Some of you saw me tweeting here after the bell tonight about Berkshire Hathaway's newest trades that they just announced. Many of you are aware that major institutions and other fund managers are required to report what's known as Form 13F with the SEC, letting everybody else know what they've been up to in the most recent quarter. So we heard from Berkshire's additions and subtractions as of the fourth quarter of 2022. If you're interested in that information, feel free to check out my Twitter feed where I've got that information posted. But they did finish the normal session down today about 1%. ExxonMobil was down today as well, about 1%. United Healthcare, another big company, down about 0.5%. So we had more of the larger companies down today, and just a handful of them that were up. So again, my hunch is that it was really Nvidia and Tesla that kind of went above and beyond on behalf of the entire stock market here today. In terms of the areas that got hit a little bit worse, I would say that the consumer staples did not, give me any warm and fuzzies here today. You can see that most of them were in the red. If I were to right-click and zoom in only on the consumer staples, you can see that maybe Monster was up by 0.03%. We had Estee Lauder up by 0.09%, but that's about as good as it got. For the most part, it was a challenging day for those consumer staples. I do know that Coca-Cola reported their earnings here this morning. Apparently not all that well received, with that stock down about 1.5% here today. Remember, it is this time of the year when Coca-Cola traditionally announces their dividend increase. Remember, they are a dividend king, meaning that they have over 50 years in a row of dividend increases. We've actually had some good commentary in both my DGI class this morning and my Options for Long-Term Investors class yesterday afternoon about dividend kings. And of course, Coca-Cola is right up there with the best of them. And so we'll find out here shortly. And I'll, of course, let everybody know as soon as I find out on Twitter if you're interested in that information there as well. Going back to the S&P 500 now, let's see what other areas were a bit out of favor. I would probably say that the utilities and real estate areas seem to be a bit out of favor here today once again. And remember, that's been an ongoing theme in 2023. We've seen the defensive areas out of favor, and we've seen the more cyclical or growth-oriented areas a bit more in favor this year, kind of the reverse of what we experienced last year. So I think today's theme was largely, this looked like a worse day than it actually was, according to what you will read in the Wall Street Journal tomorrow. And I think NVIDIA and Tesla are the reasons why things looked better than they actually were. There was way more selling, way more stocks down today than were up, despite the market's flat performance. To get some specific numbers around that, let's go ahead and take a look at our breadth over here on the Market Watch Visualize area of the Thinkorswim platform. I've got the S&P 500 pulled up, and as you can see, only 167 stocks closed higher today. So that means that only 1/3 of stocks closed in the green, 2/3 of stocks closed in the red, yet the S&P 500 was down, I believe, 0.03%. Let me just verify that by coming over here to the charts now. And yes, that was the end result, 0.03%. So if I'm not saying 3%, I'm saying 0.03%. So it's basically as close to a flat performance as you could possibly get, despite 1/3 of stocks being up and 2/3 of stocks being down. Normally, you would expect a performance where you were basically flat on the day to have a 50-50 breakdown of winners versus losers. That was not the case today. So a strange day, I would say, from that perspective. As we look at the forward grid here, you can see that a couple of these indices had a little bit wider range than normal, and that would have been the S&P 500 and the Dow Jones Industrial Average. Both of those have the orange label up there at the top with their daily range exceeding the average true range, whereas the NASDAQ Composite and the Russell 2000 down below have those labels as blue, meaning that they had less of a range than normal today. So it didn't strike me as a particularly violent day in one direction or another. To be honest, it felt like more of a stabilization type of a day, but it was kind of interesting nonetheless to see kind of that division between the wider ranges and the somewhat smaller ranges amongst these four here. The other thing that catches my eye as we look at this foregrid is that we now have all four of these charts with a light pink background color here currently. And as of today, that occurred on the S&P 500, on the Dow Jones Industrial Average, and on the NASDAQ Composite. And a reminder that that light pink background color is a result of the green line, which is basically what sets our posture when we're using the market forecast technical indicator. So that green line is also referred to as the intermediate line. When that falls out of the upper reversal zone, you will find that it's kind of giving you the suggestion that there's some bearishness, or at least some additional selling present than had been the case more recently. And I think, that is a fair statement with, the S&P 500 and the NASDAQ and the Russell 2000 all well off of their highs from about 2 weeks ago. The Dow looks a little bit different simply because it didn't really have that burst of energy to the upside that the other three had, so they didn't really have that to give back. So the Dow has kind of felt like it's been more meandering sideways to a little bit up, but has not had as much bullishness as the other three. And so when I look at the other three charts and I see the pink backgrounds creeping up in the charts, I also want to tell myself not to overthink that too much. In other words, you can get, lured into the temptation of saying, oh, well, the posture is weakly bearish now. I better load up on the bearish trades out there. And I don't really look at it that way personally. I look at those three charts and I say, yeah, there's been a little bit of selling here recently, but I don't think this is like a slam dunk for the bears at this moment. To me, it looks like these charts are all kind of stabilizing here in the last few days, and it wouldn't surprise me at all if they were, catching a bit of a bounce here, and we have a bunch of, closes above highs of low days, and this is kind of a bull flag that we're bouncing up and off of. So, we don't want to get too aggressive with our mindset there. The posture setting mechanism of the market forecast is there to kind of give us a little bit of a temperature check, not necessarily to tell us that a storm is for sure on the horizon. So until we start seeing a little bit more breakdown on the chart, where we start witnessing, some of those darker pink shadings, where things are obviously a little bit more aggressively selling, then I think we also have to give the benefit of the doubt to the bulls in this particular case, because they have carried the day so far in 2023. Like I mentioned to you last time, my mind doesn't want to believe that, but my eyes are seeing it. So you have to kind of come to terms with that one way or another. Like I mentioned in the video last time, the way that I've tried to come to terms with it myself is by doing more iron condors than I would normally, because while I can clearly see with my eyes the bullishness that exists out there, my mind doesn't want to believe it. And so rather than being wildly bullish or wildly bearish, a way that I can at least come to terms with my mindset personally is by doing neutral strategies like the iron condors. And those have actually worked out pretty nicely for us with those trades that I've shown you so far. Knock on wood, right? You never know when that will change, but most of our iron condors that I've done in the paper money account here recently have been in a profitable territory. So we'll see if we can continue that streak a little bit later on in tonight's video with our trade application example. So anyway, where things stand right now is all four of these charts remain above their rising 30-day moving averages. All four of the charts also have weekly bearish intermediate postures. So we await more data. Do keep in mind that we had the CPI reading come out this morning, and there really wasn't a big reaction to it. So I think that's also kind of a bullish feature. Yes, it's true that the S&P 500 was down just a touch today, but remember, there have been some pretty violent reactions to the CPI report in past months over the last year. And so the fact that, it was kind of a yawn or a meh type of a response today, I think is actually a little bit more promising. In other words, the bullish gains that have been established in the market this year so far have held. You're kind of out there looking for reasons that the market might find as an excuse to sell the market off. And the CPI is an obvious example of what could, be a catalyst of bearishness or selling. And other people have looked at perhaps it's the jobs number. Maybe some people are looking at all the UFO activity here in the United States over the last week saying maybe that's a catalyst to sell the market off. Of course, I'm just joking with that, but you get what I mean, that we're all just kind of looking around our shoulders waiting for the next shoe to drop, and so far the shoes aren't dropping. The markets are stable, and you've been on the wrong side of the coin if you've been too bearish so far in 2023. So we just have to recognize the truth of the situation regardless of what our minds will say. And believe me, I'm just as guilty of that as well, so I'm not here like preaching to you or anything like that. It's a lot of ways this is this is therapy for David and I, because we can share with you in sympathy what we are all likely thinking about these markets, and how we all have to kind of work our best to get through these moments to the best of our abilities, despite them feeling a little bit more confusing than perhaps other moments throughout time. So anyway, just to put a ribbon on it, the S&P 500, as I mentioned before, was down 0.03% today. The Dow Jones Industrial Average was down 0.46% today, which oddly enough was the worst performance of these four today. The NASDAQ Composite was up 0.57% today. Remember, Tesla and Nvidia are not in the Dow Jones Industrial Average, so they did not assist the Dow being the worst performer today, but they are very much major components of the NASDAQ Composite, which is likely why that tech-heavy index of the NASDAQ was able to outperform those other areas today. And then the Russell 2000 was down similar to the S&P 500. It was down just 0.06% today. So pretty boring day, to be honest with you. Not a whole lot of wild activity here outside of just a couple of those names like Tesla and Nvidia. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support us with these presentations. Many of you know it takes several hours of our day to commit to doing these free videos here for you guys on YouTube, and our hope is that we can help educate you to a degree, and also, of course, help get the word out about our organization. While we don't make money off of these free videos here on YouTube, our hope is that some folks will eventually decide to join us in our premium services where we do make money. So hopefully it's one of those situations where we can help one another out with the arrangement that we have. And so in order for us to, of course, get the word out about our business and kind of promote what it is that we offer, we ask one simple thing, that if you are thankful for the videos that you receive from us on a daily basis, the one thing that we urge you to do is click like for us there on Twitter. And as I always say, as long as we're up and over 100 likes, by the time I'm scheduled to do the video again, I'm happy to give you a full-length video that includes a trade application example at the end. Now, some of you don't like the longer videos, and that's okay as well. Remember, you can't please everybody. And so for those of you that don't like the longer form videos that include the trade application example, then don't click like on Twitter. And if the next time I'm scheduled to do the video we're under 100 likes, then I'll just plan on doing a quick 15-minute version of the video where we only look at the indices and just keep it nice and short for you. So we kind of let you guys decide collectively through your voting, so to speak, there with the heart function. Good day to talk about the heart function or the like there on Valentine's Day, of course. Hearts out to all of you. But let's do some shout outs here, as I'm wont to do. And out of the 113 people that clicked like for me last time around, I want to thank Teddy and Brandon and Trunk and HR and John and Irvin and Lucius and Nikolai and Michelle and Tom and Julie and Paul and Scott and Prickly Trader and Evolution and Leanie and Sheila and Charlie and Leon and King Lion and Roger and Christopher, Susan, T-Fib, Carlisle. The list goes on and on and on. You guys are wonderful. I thank you so much from the bottom of my heart here today on Valentine's Day. We appreciate your support. Please keep that up on your end. And how about that? Carlisle is a avid Market Scholars fan. I love that too. It's very cool to see some of our enthusiastic supporters that are out there. Thank you, Carlisle. He's done a great job with us here recently. All right, let's also have a little chat about some of the things that are on the website over here at Market Scholars. A reminder that earlier today I taught my dividend growth investing class. As always, we enjoy our conversations there about stocks that have grown their dividends. And today we concentrated on the utilities sector. And we did get a chance to review a dividend king that I had never once formally reviewed in all of my dividend classes, even stretching back to my time with TD Ameritrade. So we're talking about 8 or 9 years where I do weekly head-to-head matchups. And today today was a very first of one stock that we have never gotten a chance to look at before today. So that was kind of a fun experience. That doesn't happen all that often, right? There's only a couple hundred stocks that would probably be legitimately considered for a DGI portfolio. So we will have talked about most of them at one time or another throughout history. But every so often you have a unique situation where a stock was too strong for too long and eventually gets sold off to a point where its yield becomes a bit more attractive. And that did happen for us here today. So if you're curious about that and you're a premium member, make sure you check out the recording on our website. It is housed in the trading rooms area. Also, I think David taught his directional option strategies class today, and so feel free to check out whatever he had there for you guys in the trading room as well. Tomorrow, I'll be teaching my factor-based swing trading class first thing in the morning, and then David teaches his options inventory class, I think midday there. So lots of great stuff happening here at Market Scholars as always. Let's go ahead and get into this graphic here. This is called the sector selector. This gets updated on Friday evening, so we are a couple of days stale here at this point. Of course, if you are a premium member of Market Scholars, you would have access to it immediately on Friday night. You wouldn't have to wait here for me to perhaps talk about it on Tuesday. I say perhaps because usually I talk about this in my Tuesday video, but if we're ever under 100 likes, then that would be a day, of course, we wouldn't talk about it because I'd have to kind of scale back my presentation. So let's go ahead and have our chat about the sector selector here this evening. And as you can see, consumer discretionary continues to lead the way. This is something that I've been a little bit more proud of. Of course, I end up having plenty of egg on my face plenty of times because none of us are perfect, and we end up having lots of things go an opposite direction than we thought. And so we do our best just like anybody else, but we will make plenty of mistakes, I assure you. But one thing that I think that we did do a little bit better job of in this regard is our pointing out earlier, in this graphic, particularly back here, end of November, beginning of December, that consumer discretionary was starting to get its mojo. And what was interesting about it at that time is most people were not talking about that. That's why I try to emphasize that as much as I did, both here in the Market Outlook videos and also, of course, in my premium classes, because I got the sense by watching business television that very few other people were talking about it at that time. At that time, we were still in a somewhat struggling kind of a stock market where it was the defensive sectors that were catching everybody's attention. And I was going through consumer discretionary charts one after another saying, this is a pretty solid setup. This is a pretty strong stock. We have relative strength here, one after another. But what wasn't happening was the marquee names within consumer discretionary were not supporting that conversation. In other words, Amazon and Tesla were in the doghouse at that time. Their charts looked absolutely terrible. And from my impression, what was happening was the awful charts of Tesla and Amazon were masking the fact that most of the rest of the consumer discretionary stocks actually looked really good. And when most people look at the consumer discretionary sector just to try to get a quick gauge of what's happening, they look at XLY. That is an ETF that is the most popular discretionary sector ETF in the United States. But one of its downfalls is it is a market cap weighted ETF. And so what that means is that Tesla and Amazon are going to have a massive impact on the performance of that sector ETF. And there are going to be dozens of other stocks within that ETF that basically have no impact on it. What I'm doing here with this sector selector is an equal weighted approach or evaluation of the markets. I am not putting extra emphasis on Tesla or Amazon. And right now, with Tesla ramping higher here in this new year, perhaps that's a bad thing. But you can see it hasn't really held consumer discretionary back because regardless of whether Tesla is roaring higher or not, the last 5 weeks, we've seen consumer discretionary be stronger than most of these other areas that are out there. So I found that to be a very interesting development here over the last 3 months. months, going from 3 months ago, nobody believing in consumer discretionary because they were so stuck looking at Tesla and Amazon, to where we're at today when everybody all of a sudden is enthusiastic about consumer discretionary because Tesla keeps on going up day after day after day. But it's not just a Tesla story. If you look underneath the hood, there are tons of great looking charts, strong charts within the consumer discretionary space. A lot of home builders, as an example, have very strong charts right now. Besides consumer discretionary, you'll see that technology is in our number 2 position at this time. Technology is now at its highest level that we have seen over the last 3 months of this graphic. Notice that prior to this week, technology was ranked number 3 for a couple of weeks in a row, but for the most part, prior to the last, let's call it 2 or 3 weeks, technology was kind of in the doghouse. And I would say that this is partly due to the Microsoft effect. Again, this is an equal weighted version here, so it's not only Microsoft, but, Microsoft is a bit of a bellwether within the technology area. And I think that the attitude and sentiment towards Microsoft has improved dramatically here recently as a result of ChatGPT, and that has kind of poured a little bit more good graces into the rest of the tech world out there as well. Of course, there's a lot of semiconductor companies that have perked up. I just mentioned NVIDIA earlier, so that's helping as well. But remember, Google/Alphabet is not a technology company. Some people that are newer to the markets might be surprised to hear that because they think of Google and they automatically think of technology. But the truth of the matter is, Google is part of the communication services sector. Most of the big internet companies are, as they're more they don't make like hardware or something like that, right? They're kind of like algorithms, and they facilitate ways to communicate with people. So like a lot of your social media companies, as an example, Meta/Facebook is also a communication stock. Disney is a communication stock as being a media company and that sort of thing. So anyway, Google, unlike Microsoft, is a communication stock, and I wonder if that's part of the reason we are seeing this separation between those two areas within the last week, because most of you know, if you've turned on a TV recently, that in the business world, the whole business world is abuzz with this conversation about artificial intelligence and how all of a sudden Google looks like it could be dethroned. I think we're kind of jumping the gun a little bit, to be honest with you, on that conversation. Google will have something to say, but right now you can kind of get the sense that they are scurrying a little bit, and they're trying to play a little bit of catch up all of a sudden, which is an uncomfortable feeling for them, I'm sure, because they've been the big 800-pound gorilla for as long as we can remember, for the last 2 decades. So it's strange to see them kind of on their heels a little bit here because of what Microsoft, and not specifically Microsoft, but really their $10 billion investment in ChatGPT, and then also what that means for Bing and Internet Explorer and Edge and all their products from Microsoft going forward. So it's going to be really interesting to watch this play out in the years to come, whether Microsoft and or Alphabet ends up being superior in AI. Remember, there's probably a lot to go around. In other words, this doesn't have to be one of those situations where it's winner take all. It could be an expanding pie situation, and both of them could ultimately be big winners. But right now, the way that the stock market perceives the situation is Microsoft has a lot to gain and very little to lose in the search wars, and Google is the opposite. And so Google is kind of looking a little bit uncomfortable here, and you're seeing that reflected to a degree between the transitions here on the sector selector, with technology dominated by Microsoft going up and communications dominated by Google/Alphabet going down week over week. We also saw that the financials slipped into the number 3 territory right there, so perhaps some of those banks and other asset management companies firming up a little bit now that the stock market itself has stabilized. At the bottom, you will see that it's largely a story of defensive sectors once again. But it is worth noting that materials really fell off the cliff. Materials are a little bit goofy because there's not a lot of them. And I think that does have an impact in this regard. It allows the materials to move much more aggressively than some of these other sectors, simply because there are way fewer components within the materials sector than you will find in most of the others. So that could play a little bit of a role there. We'll keep our eye on that story. That's not necessarily what you want to see, because remember, materials are a bit more cyclical, and generally speaking, if you want a healthy bull market, you'd like to see the cyclicals outperform, but that's a little bit of a one-off, right? Most of the other cyclicals are still doing fine. Maybe it's just a situation where gold stocks have fallen out of favor, right? Gold is where you find some materials exposure there, and so gold kind of sometimes will go the opposite direction compared to other industrial metals and things like that. So that could be part of the story there as well. But anyway, I think the takeaway and the summary here is much the same as it has been in prior weeks, which is this is still another healthy sign for the market, all else being equal, where we're having kind of the growth compounding sectors leading this market right now, and we have the defensive kind of stalwart types of sectors that are sitting in the back seat and lagging at the moment. All right, let's go ahead and pop back on over here to the Thinkorswim platform, and let's do some more charting analysis. And let's do a bit of a 12 grid assessment, starting with chart 5A. Remember, this will be our asset class 12 grid. And as we're looking at this here, it's a mixed bag, right? And oftentimes is. So I don't ever want to give the impression that that's abnormal. Remember, in a way, you should assume that when I pull up chart 5A, we will never have a clean sweep of all green charts or all pink charts. We can with the sectors. That's a different story. But with this asset class, it's almost impossible to have that happen, because in some cases, like treasury yields versus treasury bonds themselves, they are inverse to one another. So it's important to kind of understand that aspect as well. So let's see what we can learn here when we dig into the data. Let's go ahead and get started in the lower right-hand corner. This is the 10-year U.S. Treasury yield, and of course, it has been a focal point of these markets here for the better part of the last year and a half or so. It's really been part of the story of the market, is dealing with the consequences of rising rates. And today we did have another day of rising rates. You can see here went up about 44 basis points to end the 10-year Treasury yield today at 3.76%. That's pretty far off of where we were at just a week and a half ago. I want to say we were down there closer to like 3.5% yield. So it's a pretty healthy little boost that we've seen here recently, but to be fair, we are still well off of some of the highest levels that we witnessed in 2022 when interest rates were up there above 4%. So and remember, the short-term rates still are. I was just looking at the 3-month bills earlier today as a result of another conversation I had with a premium member of Market Scholars today, and looking at how the 3-month bills were at, I think it was 4.77% when I checked last. So a full 100 basis points higher than the longer term 10-year interest rate, which is, again, I hate to keep on sounding like a broken record, but it is important to stress this because of how abnormal it is. You will not see a 100 basis point inverted yield curve on 3-month bills and the 10-year bonds very often throughout your career, and especially with how consistent it's been, right? Sometimes you might have some sort of a weird one-off black swan anomaly that happens, but it is quickly rectified. That has not been the case here. We have had an inverted yield curve for quite some time. And so it's been one of the more interesting times to evaluate that type of data. It's not something that most of us are used to, I can assure you. On the flip side of the conversation of interest rates going up today, remember, your assumption should be that bond prices go down on a day like that. And for the most part, that was true. You can see that TLT, our proxy for long-term U.S. Treasuries, was down 0.23% today. Not a huge down day, but nonetheless kind of struggling to bounce its way back above its moving average where it spent most of 2023 so far. But for the last week, that has not been the case. We've slipped back below the moving average. With the foreign bond market, we use BNDX as our proxy for that. It was down about 0.3% today. And again, same thing as TLT. All of a sudden, we find ourselves below the 30-day moving average here, which has not been the case for much of 2023. And then high yield bonds actually managed to close higher today, not by much. So we don't want to throw a parade for them or anything, but they were up 0.03%. So high yield bonds did outperform the other categories here today. Nonetheless, they do share that commonality with foreign bonds and long-term U.S. Treasuries that we are now trading below the 30-day moving average, and that has not been the case for most of 2023. So it does feel like there's a little bit of winds of change that have kind of entered into the system here over the last week or so that we hadn't been dealing with up until this point. It hasn't caused a lot of turmoil in the stock market yet, but you never know when it might start doing that. So let's keep our eye on that story because you just never know what the catalyst may be. Maybe it will have a spike of interest rates that are just roaring higher all of a sudden again, and we're witnessing it here in real time, even though it doesn't seem like a big deal yet to the stock market. Maybe it becomes one, next week or the week after. So that's part of the reason why we do these free videos as often as we do, so we can keep our eye on the story, right? A lot of other firms like ours also offer free stock market evaluation videos, but many of them only do it once per week on the weekend. We generally will do it multiple times per week during the week. And we know it takes a lot of our time and effort to do that, but hopefully one of the benefits we get is that we are staying on top of the ball, and most of this stuff will not evade us for too long because we're forced to look at it as often as we do when we go through the 12 grid analysis as we are doing here currently. Anyway, in the lower left-hand corner today, you will see that the US dollar is down 0.07% today. Pretty much a whimper, again, not a very big day. What I will say is that after having a pretty impressive 3-day rally right here, let me blow this up so you guys can see it a little bit better. This right here from February 2nd to the 3rd to the 6th, so that must have been a Thursday, Friday, Monday. That was actually a really strong rally for the dollar. Remember, you don't expect the world out of the dollar. It's a very liquid asset class, of course, and this is against a basket of other foreign currencies as well. So you don't see violent movements all that often, especially if there's not any major geopolitical event or anything like that. So this was actually a really good 3-day rally that you saw right here. It gave you the impression that, hey, maybe this time is different. Maybe the dollar can giddy up and go. But as we now witness here on the 14th, and looking backward to where that third of that 3-day stretch was, we have basically just gone sideways, right? In other words, we haven't built upon those gains. It's been a little bit of a whimper. One positive element is that you can see that the 30-day moving average did change to green on the chart today, which means that price is now above a rising moving average. So enough time was spent above the moving average that the moving average has now started to be bent higher. Prior to today, that was still a slightly down or declining 30-day moving average. So, is that like, some sort of an all-in type of a bet that you should make? Of course not. That should hardly ever happen in your entire career, quite frankly, because you don't know the future, right? There is no crystal ball out there. It's just one more data point that, hey, there's been enough stabilization that the bullishness is still present. On the flip side of that, it hasn't advanced. And so you can see the argument on both directions here for those that are watching the dollar right now. It could very well be, in either direction on a breakout here within a month or so. But right now, we're just kind of awaiting more information by traveling sideways. Gold has been a disappointment, at least to me. I was more optimistic about gold at the beginning of the year, and once they started producing these overbought cluster signals, I still wanted to give them the benefit of the doubt. Now, you got to be careful from the messenger. I used to be a little bit of a gold bug. I no longer am, so I think I've flushed that out of my system. But before 2008, I traded pretty much all of the gold stocks back then. I know that sounds weird because most of you guys know me today as a dividend investor, and gold stocks and dividend investing usually don't jive all that well. There's a couple of them that are maybe acceptable from that perspective, but generally speaking, those are two different universes there. So back in the day, I used to be a gold guy, and so I still keep my eye on it, even though I'm no longer as injected into that world as I used to be. Nonetheless, I think that once you get a little bit of enthusiasm around gold, sometimes it's hard to shake that. So you got to be careful if you hear me saying, you know, gold's looking really good here all of a sudden. It might just be my old spirits haunting me once again. So truth be told, when I look at the gold chart right now, I'm not particularly impressed. I'm sad to say. I was more hopeful at the beginning of the year because this was a strong trend, and you had an opportunity to play that plenty of times along the way. And in fact, we did so with one trade along the way. Fortunately for us, we didn't do more than one. The only trade that I did here in this video for gold was selling the bull put spread on Newmont Mining, and that will expire here on Friday of this week, likely at a max gain. We're still in good shape on that particular trade. And I'm fortunate that I ended up doing a bull put spread on it as opposed to, let's say, buying calls on it, because I can assure you that we would not have had as good of an experience with that. So sometimes it's better to be lucky than good. But in that particular case, strategy selection was equally as important as the underlying security that you were trading. Because as you can see, for the last couple of weeks, gold itself has started to break down. Now, obviously, it's still up over the last 3 months. We don't want to throw it under the bus. We're up about 5% over that time period. But, you know, the impression of the chart here currently is a lot different than the impression was, let's say, a couple of weeks ago here when it seemed like it was just, you know, up and away. Today, it kind of feels like that balloon has been pricked a little bit, or perhaps shot out of the sky by an F-22 with a sidewinder. Some of you will get that reference. But this one feels like it is now descending a bit. And while today it was up just a touch, it didn't give you the impression that it was like some sort of a, you know, hey, I'm back, baby type of a move. It was, hey, let's just stop the bleeding a little bit. So we need a little bit more constructive price activity here on gold before we can get too enthusiastic about it again moving forward. But I will keep my eye on it, and if things do change in that regard, I will be more than happy to share my opinion with you on that. On the flip side of that conversation, I've actually become maybe a little bit more impressed with oil. You know, oil didn't look particularly good at the beginning of the year. It was really choppy, and even right now, it's still kind of in that choppy territory. But what I can say about oil is, hey, at least we're above the moving average, and at least we're back to a strongly bullish posture. Is this the best looking trend that you'll ever see? No, it's not. It's still a pretty ugly looking chart, but it's not one that I think is dominated by the bears at the moment. I think the bulls have just as equal of an opportunity to take this thing and run with it to the upside as the bears do to take it to the downside. And some of the stocks out there, like you know, one of the stocks we talked about as an example in one of my classes today was ExxonMobil, you know, and Chevron, and you know, actually Chevron doesn't look so good. I hadn't really noticed that, but Exxon looks great. Conoco doesn't look so hot. Let's take a look at EOG. It's looking a little bit better, but oddly enough, it seems like it's Exxon that is kind of not only the big kahuna of the space right now, but also one of the stronger trending charts that are out there. So that probably bodes somewhat well for XLE. Remember, XLE as a market cap weighted ETF has a lot more exposure to Exxon and Chevron, so Chevron is a little bit of an offsetting there, but this chart doesn't look half bad either, right? You can see it stabilizing there above that rising moving average, kind of matching, quite frankly, what we're seeing out of oil. So, you know, we'll keep our eye on it. It seems like the bulls have an equally as good of a chance to take this thing and run with it if they want to, right? And we'll see if they do. On the top line items here, you can see that the foreign stock market, at least in the developed world, was up here today. And so it outperformed the U.S. market. You can see that it was up 0.18%. However, the foreign emerging stocks were the opposite. They underperformed the U.S. market today. And like I was mentioning here last week, it still has a weekly bearish posture. In fact, it's kind of deteriorated a little bit. At least last week when we were looking at EEM, it was kind of riding that 30-day moving average higher, giving you the impression that, hey, it might be willing to bounce for us here. Well, here we are a few days later, and we've gained new evidence, and the evidence is not necessarily particularly bullish at this moment. It looks like it's comfortable spending time below that moving average, and generally speaking, you want that moving average to act as a bit of a support area that it can bounce up and off of, not slice through. So right now, it seems like it's the developed world that seems more attractive from at least a technical analysis perspective than the emerging world. So, you might go hunting around in Europe, perhaps in Australia, Japan, some of those areas that make up EFA for some of the stronger charts that are out there. Preferred stocks had a nice little 3-day bounce here that they're in the midst of. Remember, preferred stocks we don't really talk a lot about, but they really caught my eye at the beginning of this year for this unbelievable streak of daily wins, which is almost unheard of for an entire asset class. Eventually, those good times went away because things got too good, right? And the party ended. Sometimes you imbibe a few too many beverages and the party ends a little bit earlier than you'd prefer, right? And that kind of happens here in the stock market as well. After imbibing a lot of beverages at that party, we got a little bit too excitable here at the end, and then you just kind of crashed, right? And that's the hangover effect right there. Well, the good news is it looks like they popped a couple of Alka-Seltzer, and they're off to the races again. So some good stabilization there on the preferred stocks chart, and we're using PFF as our proxy for that. Bitcoin down a little bit in the normal session here today, but pretty much flat here, at least as we speak here in the after hours session. But again, Bitcoin had one heck of a move at the beginning of this calendar year, and what's impressive about it, at least so far, is that it's pretty much holding, right? It's not necessarily giving that back. It's saying, hey, we're taking a little bit of a breather for the moment, but it feels a bit different than most of those monthly periods that we experienced with Bitcoin last year, where it was decidedly more bearish. Right now, I think it's still in the bullish camp, at least from my perspective. Let's go ahead and see what's going on with a sector basis now, chart 5C for our sectors. All right, so as this pulls up here, you can kind of see we've got a bit of a mixed bag from a sector perspective here today as well. And remember here, that's not necessarily a given. There are plenty of times where we have all pink charts or all green charts. But today it's kind of one of those, split down the middle, flip a coin type of a moments where some of our charts are improving and some of them are weakening. And so we're seeing a transition taking place, actual sector rotation, right? It's not just they're all going up just at different degrees. We actually have some sectors that are going up at the same time some sectors are going down. And remember, that oftentimes means it's a little bit better of a trading environment for those of you that are looking for that and spotting some of those rotations that are taking place. So as it stands here today, you can see that the big winner was Discretionary. And again, this is XLY, the market cap weighted version of Discretionary. So I have no doubt that much of the reason that this sector did so much better than the rest, being up 1.2%, is squarely on the back of Tesla. Tesla had a great day today, up 8%. And since they are one of the two most important companies in XLY that carry the heaviest weight, it gave them an added benefit in that particular sector today. In addition to that, no surprise, guess who the second best performing sector was? Technology. I say that because, of course, we just looked at the sector selector, which was not produced based upon today's information. It was produced based upon Friday's information. So we were given a heads up by the sector selector that those are the areas that are in favor, and the market is proving us right on that point, at least today, because technology was up 0.43%. And again, that is probably due to the NVIDIA effect in that case. Remember when we were looking at the heat map at the beginning of the presentation, I said, today's market stability is because of two stocks, from my opinion. And those two stocks are Tesla and NVIDIA, and they happen to belong to two different sectors, but they're both very important within their sectors. And so NVIDIA, I think, is the reason that technology was able to become the second best performing sector here today from a market cap weighted perspective. Other than that, you didn't have a lot of green out there today. Communications closed up just a skosh, 0.04%, so nothing to write home about. Same thing for energy, up 0.03%, and then materials maybe a touch better, up 0.23%. All the rest of the charts were down today. In terms of who the worst performing sector was, it was real estate. It was down over 1% today, 1.04%. Real estate actually looks kind of interesting to me here, simply because it's looking different than these other defensive sectors at the bottom. Notice healthcare, notice staples, notice utilities. They're all still trading below their falling moving averages. Then look at real estate. It's still got a rising moving average that it is trading above. We have given back some of those really generous gains that real estate gave us here a few weeks ago, but we're setting up at an area right now where I could easily envision stabilization and a bounce and up and off of that moving average. So I'm going to be on the lookout for that. Like, obviously, we didn't get it today. It was the worst performing sector, but I'm not counting out the prospects of that possibility, right? We're in that general region where we are testing support at a prior area of resistance. And a lot of times that's where you're going to start looking for those bounce opportunities. So keep your eye on real estate. You might be setting up for some nice hold bounce patterns here sooner rather than later. And of course, we'll be talking about that very concept tomorrow morning in my factor-based swing trading class. So we'll keep our eyes open for that. In terms of where the stronger bearish postures are right now, staples and utilities have our two strongly bearish postures. And in terms of strongly bullish postures, there's four of them: financials, technology, energy, and discretionary. All right, let's go ahead and get into our trade application example today. And I'm in one of those moods, right? Sometimes you get into a mood. And today's Valentine's Day. You got to have a little bit of fun with things, right? You only go through this life once, right? There's no dress rehearsal. So you got to have a little bit of fun. Sometimes we take ourselves a little too seriously in the financials business. So in a spirit of having a little bit of fun today, I decided, hey, let's look at ticker symbol LOVE. And in this case, it's spelled L-U-V. And who doesn't want a little bit more love on Valentine's Day? So in this particular case, this is Southwest Airlines. And for those of you at least that live in the United States, most of you know why their ticker symbol is LOVE. They're always associated with the heart logo and all that kind of stuff. And even internationally these days, I know Southwest has started to expand to other parts of the globe as well. They're not nearly as well known overseas as they are here in the U.S., but nonetheless, they are continuing to attempt to, expand their empire. And of course, a few weeks ago, they were very much in the news for all the wrong reasons, as their systems were breaking down and all kinds of flights were delayed and canceled and people were up in arms in the airports and all that kind of stuff. Well, things have seemingly cooled down from that perspective here currently in February. You never know when something like that could come out of the woodwork once again, but for right now, it seems like, hey, cooler heads have prevailed. And while there's still probably a lot of people that are upset with Southwest out there, they still have their defenders as well, right? They have one of the most loyal groups of supporters out there, as well as the detractors. So I guess it's fitting that the strategy that I implemented here, as I've let the cat out of the bag earlier in the presentation, is an iron condor, right? An iron condor, for those of you that are newer to the idea, is where you're not necessarily picking sides. You're saying, hey, there's lots of supporters and lots of detractors, and that ends up balancing the scales, so to speak. And if you can find a stock that ultimately goes sideways, you can still make money in the stock market. I think there's a lot of newer folks in the market that don't realize that. They think, okay, in order for me to make money in the stock market, I got to pick the next great stock, and I got to make sure that I do that at a consistent rate in order to outperform the market at large. Well, the truth of the matter is there's a lot of strategies out there. There's a lot of roads to Rome, or perhaps in this case, skyways or airways to Rome, right? And so keep in mind that if you have a knack for being able to pick stocks that don't go anywhere, it's almost as valuable of a gift as picking the stocks that will either go up or down. Maybe not quite as much, because I do think that there's more upside alpha generating opportunity if you can find stocks that are about to collapse or the ones that are about to skyrocket. Nonetheless, there are still very good returns that can be generated by finding stocks that do nothing at all. And when I say returns that are reasonable, what we shoot for oftentimes with our credit spreads are 30% return on risk. And that was the case that I was able to achieve here with Southwest Airlines. However, there is one major caveat. And remember, I did this trade already when the market was open today, and I do that to give the benefit to those premium market scholars that are out there that are on our Telegram channel that can learn that information in advance of everybody else doing the free videos. But the major caveat is normally when I'm doing options trade, unless you guys hear me say otherwise, I'm doing the monthly contracts. In today's case, I was not able to achieve that to the degree that I felt comfortable with. And so in today's trade, I actually did weekly options, and the week specifically that I selected was March 31st. And so we'll be in this one a little bit longer, but part of the reason I chose to do that is because I didn't feel all that comfortable with my break-evens on the normal March monthly contracts. Perhaps some of you would feel more comfortable with that. Of course, everybody will look at it a little bit differently. It's always in the eye of the beholder, so to speak. But in this case, I was reasonably pleased with my break-evens. And when I mean break-evens, for those of you that are newer to iron condors, what you're effectively doing is you're selling two credit spreads. You're selling a bear call spread up at the top, and you're selling a bull put spread down at the bottom. And that creates break-evens. And that's what those two blue lines that you see on my chart represent. And up here you can see the numbers that are associated with the lines. On this one up here, it's 39.24. And this one down below is 31.76, because I did $1 wides in this case, and I got 24 cents of credit. And so that's what amounts to your 30% return on risk there. So in this case, I basically, on the sold put side of the equation down below, the sold put spread side of the equation, I sold the 32 put and I bought the 31 put. And on the top side, on the call spread, I sold the 39 call and I bought the 40 call. And as you can see, that makes me feel reasonably good about this trade, simply because, at least on the bottom side, we have not breached that blue line for the last 3 months of this chart. And on the top side, we have breached it, but only for the briefest of moments. Truth be told, I did try to get the iron condor done with the 40-41 strikes up at the top, but I was not able to achieve an acceptable enough credit. I would have had to reduce my standards of a 30% return on risk if I wanted to have the extra benefit of having my break-evens above these highs. So I kind of caved in, so to speak, to the market makers, and I opted to allow them to force me into doing the 39.40s up here. Not ideal, perhaps, but I still think it's a reasonable setup here, because as you can see, Southwest is trading at around 35.5, and so you've got yourself about $4 of upside, cushion, and you've got yourself about $4 of downside cushion as well. This one you could kind of see it either way. It's got a nice little bounce that it's in the midst of right now for the last couple of days, and you can see the background color has changed blue, telling us that the near-term line now has a bullish posture. On the flip side, the green line has a bearish posture, right? The green line is falling at this moment in time. time. In addition to that, you're trading below the rising moving average at this time, which who knows, maybe that will be acted as a resistance point, right? And it can't quite breach it to the upside. So we kind of seem to be in a bit of a holding pattern on the tarmac, so to speak, if you can stick with my my cheesy puns here tonight. And love on Valentine's Day in this case is what we identify as a neutral strategy, an iron condor on Southwest Airlines. Okay, so that's what I had for you here today. Our hope is that this one continues to just move sideways here for the next month and a half. So if you enjoyed tonight's video, I ask one simple request out of you. Help support the video by clicking like for us on Twitter. Remember, it's completely free for you to do that, and oftentimes only takes you 5 seconds out of your day. If you, on the other hand, want me to do shorter videos in the future with no trade application examples like this one I showed you here with Southwest Airlines, then feel free not to click like. And then in those cases where we're under 100 likes, I'll just plan on keeping it nice and short for you guys, only 15 minutes there. So we'll let you guys decide here in the next couple of days before I'm scheduled to do the video again on Thursday. Regardless of what you decide, I appreciate you checking out the video here tonight. And of course, I'm sending my love your way for your Valentine's Day, and hopefully that special someone in your life here this evening. And of course, we share our passion with you during these videos as well. So with that, enjoy the rest of your evening. I'll look forward to seeing y'all in a video real soon. Best of success with your trades and your investments. Goodbye for now.